The top chart is back to 2020. Silver versus gold. You divide an ounce of silver into an ounce of gold, express it as a percent. And back then we were under 1% in early 2020. And it exploded to 1.5% in a matter of a year. After that, silver, though going up in price mostly, had an erosional backing off on the performance. And it developed a downtrend and also a green horizontal ceiling. It blew through both last month. So not only are the monetary metals now going to beat the S&P, but within the monetary metals, silver is going to lead gold, is our argument. And I have certain expectations of silver that are rough, but at minimum, I think you could see $200 silver in the next 6 months or so. Sounds lunatic? No.
Silver takes center stage in this conversation because nothing about the current charts suggests ordinary behavior. They suggest acceleration. In the past few months, silver has broken above a long-term downtrend and a price ceiling that had held since 2021. This kind of breakout is a classic sign of market leadership, meaning silver is now moving faster and stronger than gold. And when a more volatile metal like silver takes the lead while gold is also rising, it usually means investors are shifting into assets that benefit the most from financial pressure. In simple terms, silver tends to move more than gold, especially on the upside. Michael Oliver believes silver isn't just another trade. He sees it as the main driver in the early, explosive stage of a new bull cycle. Importantly, he thinks this move will play out over months, not years. Oliver also highlights that gold and silver are breaking out compared to the S&P 500, something that hasn't happened in over a decade. When precious metals start outperforming the stock market on this scale, it often signals a major change in the financial environment, not just a short-term rally. In past cycles, like 1979 and 1980 and 2010 and 2011, silver's strong performance compared to stocks was a warning sign that huge price spikes were coming. Today, gold, silver, and mining stocks are all breaking out at the same time, which is the kind of confirmation long-term investors usually wait for before taking big positions. Michael Oliver is unusually confident right now. He believes the current chart setup, combined with growing economic stress, makes a move toward $200 per ounce for silver in the next 6 months realistic, and even a conservative estimate. He isn't guessing. He points to past periods when similar chart patterns led to huge price jumps in a short amount of time. He also connects this with broader economic factors: falling real interest rates, rising government debt, and strong physical metal buying by countries outside the West. Put together, these conditions make silver a high upside, low downside opportunity, the sort of setup where a small move against you is possible, but the potential gains are much larger. In today's video, we'll break all of this down: the silver to gold ratio, why outperforming the S&P 500 matters, and exactly how Michael Oliver is positioning for this move. If you want to stay ahead of what could be the most explosive phase of the silver market in over a decade, don't just watch this. Lock in now. Hit subscribe, tap the bell, and follow this channel so you never miss the signals, setups, and market shifts that can make the difference between catching the move or watching it pass you by. We appreciate the support and hope you enjoy the video.
Gold versus the S&P 500. Gold has broken out only now. Let's elaborate on that, Michael.
Yeah, well, what you're looking at is a spread chart, meaning I divide an ounce of gold. I use the front month active COMEX future. Right now, that'd be the February 26 contract. December's in delivery, so we rotate to the Feb. So the February gold contract, which right now is 42.40, I think, as we speak. But last month, these are monthly closes you're looking at here, are plotted. What's the price of gold expressed as a percent of the price of the S&P? And you just simply plot those charts every month. Here we go back to 2013, and that was the year in which gold, after the 2011 high, really started to implode in 2013. And naturally, its relative performance to the S&P, this spread chart, was in collapse mode as well. And by the time you got to late 2015, that spread dropped down to about 50%. That's on the left side of that chart there, where the first low, just above 50. And gold at that point, if you draw a line sideways from late 2015 on this spread chart, you'll notice it's been above and below that level, zigzagging for 10 years. So almost you could say gold's been par to the S&P in terms of performance. Sometimes better, sometimes worse, but net on balance at that, let's say that low in 2015 at about 51%. It's been either side of it. So you could have flipped the coin back in 2015 and bought gold or bought the S&P. And for most of those years, you'd be making money or losing money or making money, nothing, in other words. Okay. Right now, what's happened is that close in November took out a 1, 2, 3, 4-point trend line, almost flat, across every single rally high in that spread, going back to 2014 rally, in late 2014, its first peak. That is a beautiful trend line. If this were a price chart of ABC stock, and you broke out over that line and you were looking at the price chart, what would you say? Oh, we have a breakout. I got to buy that thing. Okay. This is a fresh breakout. What it's saying is, yeah, we've seen strength in gold since early, 2024. Actually, you can see its spread went from 40% up to 60, but it's only just now broken out. So this game is really just beginning. The movement of money into gold, monetary metals, and out of the stock market. Important chart. We run momentum studies of these charts too. In fact, later on, we'll look at one regarding silver. But the point is that when you get this kind of breakout, and its momentum has also done the same thing, except earlier, it's saying something big. It's saying this is a monstrous base of monetary metals holding their ground versus the paper bubble. Everybody's cheering the stock market for the last 10 years, but nobody's noticing that you could have flipped the coin every 6 months and either been ahead or behind in gold relative to the stock market, but basically net sideways, meaning as well as the S&P. Nobody notices that. And I love that because they notice it later, But anyway, this is a breakout and it indicates something. You're not going up for 2-3 months here. This is going up for a couple of years, and God knows where it's going. But this is a massive base that will have a massive move, and it just began. So people who look at a gold chart and say, oh my gosh, that's so steep, it's gained so much ground, they need to step back a bit. And another thing about gold, if you go back for the last 50 years since it was legalized in the US, you've had two bull markets that were eightfold, bear low to bull high. There's 1976 bear low to 1980 high, 2001 to 2011. Both were eightfold dimension gains from low to high. We're only fourfold. Our low was 1,050. We're 4,200. You go about mid 8,000 area and you can say, oh, I've at least matched the two prior bull markets in terms of dimensionality. So even on that metric, gold is hardly overdone. It's at least matched the old highs, and everybody will think it's overdone there. They think it's overdone the whole way up, and I love that because that keeps it going. If everybody's on board, and we know that the Western world, especially the U.S., is not on board, the average investor. When they finally get in, it's going to be a wet bar of soap type phenomenon, especially silver. My own personal conviction, my personal positions in markets heavily emphasize monetary metals, but especially silver. Now, on this page, we show the gold miners going back to 2013 versus S&P. They've also broken out. Then the bottom chart there is silver price divided into S&P going back to 2013. You also had a downtrend. You broke out above it too. So all the monetary metals and their miners just broke out over an 11-year wide performance base. It's just begun. It's not just gold. It's the miners as well. It's silver. Monetary metals and their miners have shifted into bull phase versus paper bubble. And the next page is the most illuminating of all, if you want to do that one.
Absolutely.
Okay. The top chart is back to 2020. Silver versus gold. You divide an ounce of silver into an ounce of gold, express it as a percent. And back then we were under 1% in early 2020. And it exploded to 1.5% in a matter of a year. That was during that 2020 surge in the monetary metals. Gold went up 40%, silver doubled. So the spread increased. After that, silver, though going up in price mostly, had an erosional backing off on the performance. And it developed a downtrend and also a green horizontal ceiling. It blew through both last month. It's fully broken out of a massive base that goes back to 2021 on that green line, which is the most important one. So not only are the monetary metals now going to beat the S&P, but within the monetary metals, silver is going to lead gold, is our argument. And I have certain expectations of silver that are rough, but at minimum, I think you could see $200 silver in the next 6 months or so. Sounds lunatic? No. There's many other historical comparisons where other markets have done comparable events with far less fundamental driving factors than silver has right now. And it wouldn't shock me to see silver at some point in the next couple years during this, what I think is an oncoming crisis, to be $1,000 an ounce. God knows where gold might be at that time. It might be highly likely to be institutionalized as a money unit again.
What Michael Oliver is laying out here is something most mainstream analysts still refuse to accept. We are not dealing with a normal gold rally. We're looking at a structural rotation, a multi-year migration of capital out of an overextended, debt-driven equity bubble and back into monetary assets that actually command trust. And the clearest way to see this isn't by staring at the nominal price of gold, but by studying its performance relative to the S&P 500. For an entire decade, gold has essentially moved in lockstep with the index, sometimes above, sometimes below, but always within the same 10-year range. Oliver's spread chart confirms a decisive breakout, one powerful enough to reverse a decade of stagnation. And what's more important is momentum. His models flipped bullish even earlier than the price ratio itself. In other words, the turn has already happened, and the charts are now validating what the underlying pressure has been signaling for months. And it's not just gold. The miners have broken out. Silver has broken out. Even the relative performance of silver to the S&P 500 has exited an 11-year base. These are not isolated fireworks. These are synchronized signals across the entire monetary metals complex. When you see gold, silver, and miners all outperform the S&P at the same time, it is not a trade. It is a cycle turning.
Let me talk about this chart here. If you take this one back 50 years, everybody looks at the ratio scale. Fine, it's fine. It's just an upside-down version of this. The bull market in 79.80 took silver to 6.5% of the price of gold. The bull market in 2010-11, when silver hit $50 again, was at 3.5%. Right now, this chart is not up to date. Right now, we're pushing up toward 1.4%. But even 1.4 to go up to 3.5, which it was during the last bull market, is a huge gain. It's almost tripling in the relative value of silver to gold. God forbid you go to the 1980 peak reading, which would have 6.5% the price of gold. And silver's not going up, by the way, and gold's sitting still. So as we're measuring silver relative to gold, we're measuring silver versus another rising market as well. So it's kind of hard to tell. We think this spread is likely to go in this surge up to at least 3%, meaning silver should at least double and a half. And once the spread breaks out, by the way, which it has just now, silver gold, you go back to 79, you'll see a similar incident in the summer of 79. 5 months later, silver quadrupled to almost quintupled in 5 months. 2010 to 11, the last 7 months of that bull trend, silver doubled in a half in 7 months in net price. Think about it, and then realize.
Now we have social media, so the trend is going to the time frame is going to be
much shorter. We have a much bigger crisis. We have a much bigger crisis.
Yeah,
silver's headed for a new reality. That's what's happening. This is my position. Everybody's different because everybody has either more money, less money, more time sensitive, less time sensitive. Doesn't want to do leverage, etc. I'm entirely in silver portion of the monetary metals. I own calls on SLV. AGQ is a double ETF of silver. I own that. I own the top 4 biggest silver miners. I also have long-term or LEAP calls on the top 4 big silver miners. I own about 7 or 8 junior miners, and I'm likely to increase that. I think in particular, as silver explodes, the silver miners will go absolutely berserk. They are vastly undervalued to gold miners. And you'll see on the bottom chart there, that's SIL versus GDX. That's the silver miner ETF versus GDX, which does contain, by the way, some silver miners. Look at that spread. It's crowding for the last 4 months, that green line. And right now, I think you're marginally above it. This is as of last month's close. So when that breaks out, the silver miners versus the gold miners, that's when you're going to see an echo effect of what silver's doing versus gold, breaking out, in which case the best place to be among the miners should probably be some emphasis on the silver miners. I think they have much more potential percentage gain, and it could be very dramatic. I don't just mean doubling, if you know what I mean. I mean dramatic. And it's a tiny little sector. As the money flows into it, it skirts it up.
It is a tiny sector, Michael. It's really difficult to find pure play silver companies anyway. I think there's 3 at best.
Well, there's a lot of juniors.
That, right?
Yeah, there's a lot of juniors, and fortunately for silver, the fundamental is that most silver doesn't come from silver mines. It comes from base metal miners who produce silver on the side as a marginal product. Hence, their primary motivation or profit-driven factor is the price of copper or the price of some other base metal, not the price of silver. It doesn't motivate them to mine more copper to get the little bit of silver they get out. So the silver miners are highly focused little beasts that even if they're tiny little guys, and maybe the cost of production at $30 an ounce was not really good for them. Now suddenly we're pushing towards 60. What if suddenly you're 150? Suddenly these once seemingly worthless little mines, which have the real thing under the ground, think about it that way, they got the bullion under the ground, suddenly are perceived to be, holy cow, I'm buying this little junior miner. What I'm really doing is buying bullion at 10 cents on the dollar. Okay, so that's why my emphasis is there.
And now we come to the most explosive part of Michael Oliver's analysis: silver's relative pressure against gold, a ratio that has historically telegraphed every major silver mania of the last half-century. In past cycles, silver didn't just outperform, it multiplied against gold at a speed and magnitude few markets have ever matched. When the ratio broke out in 1979, silver quadrupled in 5 months. In the final phase of the 2010 and 2011 move, silver doubled and a half in 7 months. That's the historical backdrop. And today's setup is, by Oliver's own words, even stronger. The silver to gold spread has just smashed through a multi-year downtrend and a horizontal ceiling that's held since 2021. That combination rarely appears in monetary history without triggering violent follow-through. Even a move back to the 2011 level of 3.5% would imply a near tripling of silver's relative value against gold, while gold itself is rising, and a return to the 1980 extreme at 6.5% would be nothing short of a super spike. This is why Oliver's minimum target is so startling. He's not talking about 50 silver. He's not talking about $100 silver. He believes the conditions are already in place for $200 silver within 6 months, and says it is entirely plausible that silver reaches $1,000 an ounce during the next systemic crisis. Most analysts will mock the numbers, but those same analysts dismissed every major turning point in the metals for decades. So as this cycle accelerates, silver is positioning itself not just as a hedge, but as the highest beta expression of monetary stress. And for investors who understand cycles, who understand momentum, and who understand that every major metals bull run is fueled by disbelief until the final stage, the window is still open, but it won't stay open forever. If you want more deep dive breakdowns like this, with data, context, and the kind of analysis you won't hear on mainstream financial media, make sure to like this video, subscribe, and turn on notifications. We're just getting started.